And, okay. So let's begin with our roll call.
Of course. Jerry Abrahams?
Here.
Phil DeFranzo?
Here.
Catherine McKinnon?
Here.
Commissioner Perez?
Here.
Franklin Perry? Chelsea Ross? Sarah Sanders?
Here.
We do have a quorum in attendance for the meeting.
Good, well, let's get to it right away. We have a couple of resolutions. The first item is for Hazim to talk about the next bond sale.
Good morning. The following resolution is to authorize CHFA to issue up to 375 million of the Housing Mortgage Finance Program bonds in one or more issuances. The sale will allow CHFA to raise additional lending proceeds and fund about 1,300 first-time homebuyer loans. As of November 13, CHFA had an aggregate net pipeline of about 323 million. Based on the interest rate environment, CHFA plans to utilize a structure consisting of fixed rate and variable rate and expect to close the issuance in February 2026. To leverage CHFA tax-exempt issuance capacity, CHFA intends to lend the tax-exempt proceeds with taxable bonds. CHFA has informed RBC Capital Markets to be the first single-family financing in 2026. We're bringing the resolution this month because we do not have a meeting in December. So that's the reason why. And I'll be happy to answer any question regarding the resolution.
One quick question, is it taxable because you don't have enough volume cap, or is it part of your strategy?
It is essentially that. So we're using taxable to supplement the tax exempt, and we're also using or considering variable rate to offset the higher cost of capital due to the taxable sale.
Will you have a swap?
Yes, if we do issue variable rate, we will utilize a swap.
You'll bid out the swap,
Yes.
and then who bids it out for us?
For 2026, it will be King Mitter.
Any other questions on this? Looks like a standard sale with a few whistles. May I have a motion?
So move.
Second. A verbal vote, all in favor of the resolution? Aye.
Aye.
Opposed, abstaining? Motion is approved.
Thank you. The next resolution is regarding the 2026 CHFA budget. On October 30th, we provided and presented CHFA's proposed 2026 operating budget totaling 48 million to the board of directors. Of the 48 million, 34.2 million is for salaries and benefits. 12.7 million is for ongoing general and administrative expenses, and 1.1 million is for capital expenses. Additional details and explanations were also included in the presentation. Since the presentation, we finalized our projected net earnings calculation and updated the proposed lending plan accordingly. Finally, we did not receive any comments from any board members regarding the draft budget. In summary, the 2026 operating budget is 5% or 2.5 million lower when we compare it to the 2025 budget. This is due to the budget for salaries and benefits, which includes a 4.5% allocation for COLA merit, is 1.8 million higher than the prior year. The budget for ongoing general administrative expenses is 456,000 lower than the prior year, and the budget for capital expenses is 3.9 million lower than the prior year. With that, I'll be happy to take any questions regarding the proposed budget for 2026.
Yes, go ahead, Jay.
Hey, Azim, so on the capital, why did we not spend? So in 2025,
Yes,
we had 5 million budgeted.
correct.
Didn't spend very little of it, right?
Right.
And so now for 2026, you're reducing it's, you're budgeting very little.
Right. So this is something that we are going to discuss later on after the board meeting at the retreat. So it's pertaining to the building, the 999 West. So when we presented the budget or asked for approval last year, one of the plans was to have enough allocation to pay for any maintenance relating to the building. Since then, we did some research, had a lot of meeting, established a task force to determine whether or not we should continue to expend CHFA dollars to maintain the building or to plan for something else. So the idea is to not assign additional capital until we have the retreat and future discussion with the board. And that's the reason why that if you look at the memo, we did insert that depending to the decision made by the board, we may come back to the board to amend
The
to
capital.
ensure that we have enough for the capital. So that's essentially the strategy.
Any other questions on the budget? We had a presentation last meeting. May I have a motion to approve?
So moved.
Second.
Any further discussion? Call for a verbal vote. All in favor, say aye.
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 Opposed? Abstaining? The item passes. Before we go further, I'd like to ask our financial advisor who's here today to introduce himself, because we don't get together that often in person. And I know King Manor is very well respected in the housing market. Maybe just talk about what you do for us and introduce yourself a little bit.
Sure. Hi, I'm Ansel Kane. I'm the president of Kane Mitter. We are currently the #1 ranked financial advisor in the municipal housing space. We work with 22 state HFAs around the country. I've personally been with the firm for 17 years. And as far as the work we do for CHFA, we advise on the pricing and the issuance of the bonds. We advise on various financial agreements like liquidity facilities. And beginning in 2026, we will also be the authority swap advisor. Great to be here.
Anyone have any questions for Ansel? Nice. Thank you for joining us. Will you be with the strategic planning session this afternoon?
I will not.
Okay, very good. Okay, on to some of our reports. Next item is the 2005 Series E bond issue. Bank of America will be presenting.
Yeah, so here with us in person is Mike Castle representing Bank of America. Bank of America was the lead manager for the fixed rate 2025 Series E single family transaction. So Mike is going to walk through the pricing book. For those who are here in person, we do have a physical book, but if not, please refer to the slides. Lauren is going to pilot, and then Mike, if there's pages that you want her to focus on, we'll make sure that it's showing the right one. So with that, Mike.
Sure.
Take it away.
Thank you, Hazim. I have one more hard copy if somebody wants it. I didn't bring many because I was told you had them up on you. Okay.
Trying to be green.
That's why I only printed 8.
It's cool.
I'm happy.
I know
In the same spirit as your social.
Okay.
Thank you very much. My name again is Mike Kessel. I used to be with Citibank. I ran the housing group there for about 15, 16 years. And I think most of the people at the table know what happened to Citibank when it came to municipal finance. And I moved to Bank of America very happily about a year and a half ago. And I'm representing Bank of America today on this transaction. And thank you very much for placing your trust with us. I'll try to describe as best I can what happened with the E1 and the E2 bonds. Turning to page 1, if you want to put that up, Lorraine. We've got just an overview of some of the key characteristics of the transaction. The sale date here is listed as October 29th. That was the date of the written award. The bonds actually priced on Tuesday, the 28th, and we started marketing them the prior Friday, the 24th. Closing date was November 13th, past tense. It consisted of the E1 and the E2 bonds. The E1 bonds were non-AMT social bonds consisting of $20 million in bonds, rather small size for Connecticut. On the other hand, the taxable bonds, the E2 bonds, also social bonds, were almost $170 million in total size. So it tells a tale of two cities here when it comes to two different markets, I might add, when it comes to the two different sizes on the bond series. Structure I'll go through in a little bit more. Obviously, the small size of the tax exempt meant that there were some serials up front and a single term bond. The taxable bonds had the full array of bond types from serial to a couple of term bonds, and then a long dated pack term bond maturing in 2055. These were for single family loan originations and rated the usual AAA by everybody. It mentions here Kane Bitter, so happy to have them table with me today. Flipping the page, kind of going through the markets where they've been recently. This is a summary job of that. Key factor going into this pricing was the federal shutdown was still happening. This was just a short 3 weeks ago. That was still happening, and to some extent, because of that, we were flying in the dark. There was the absence of some economic releases, in particular employment data, that impacted the market's decision with respect to certain things. We did, however, have I believe it was Friday before the pricing, there was a CPI release for September that came in at 3%. I believe that was a little bit lower than expected, but still far off the 2% target, which the Fed has continued, as evidenced by the Fed meeting that took place later that week. 2% remains the target that I would like to hit. Fed did meet Tuesday and Wednesday. We priced on Tuesday. We award on Wednesday. Wednesday afternoon, the Fed reduced its overnight rate by 25 basis points. There was a little noise around that I'll come back to. The week leading into the pricing was pretty stable. You can see that in the chart there in the middle of the left-hand column. One of the big things happening that was important with respect to our transaction was that there was a very, very, very heavy municipal calendar the week before, 17 billion. That's a big number to throw down. Our week was a little bit quieter on the general municipal side, but it was a heavy week for housing. It was $1.5 billion, and Bank of America underwrote about $1 billion of that, including this largest transaction for Connecticut housing. Looking at the interest rate charts on the right-hand side there, interest rates have trended down for much of the last 3 or 4 months. You can see that on the upper right chart on the right-hand side of the column. And one of the other things that we've been seeing is with Fed reductions on the short end and a little more tepid response on the long end, the yield curve has been generally steepening. Flipping the page, this is pricing summary at the top. This is page 3. Thanks, Larry. This really kind of runs through our strategy. As I indicated, we put out a pre-marketing wire on Friday, the 24th, had a conversation with Connecticut Housing, and Kane Bitter was involved in all of these calls too. I thought we had very, very aggressive pricing going into the pre-marketing period. That tends to be our strategy. It tends to be Kane Bitter's, and it's served us very well in general for Connecticut. Monday was all about marketing the bonds. It was continuing that pre-marketing period in anticipation of a single day pricing on Tuesday. A little bit unusual, but with the volatility in the marketplace, a lot of people are tending in that direction just to get risk off the table. And that proved to be the right strategy. In fact, we accelerated even a bit more in the context of what happened on Tuesday. Retail orders taken in the morning of Tuesday. The tax exempt bonds were extremely well received. I'll go into a little more detail on that in a second. The taxable a little less well received. We'll talk about that at length too. Because the market was moving against us in the course of the day on Tuesday, we decided to skip the guidance phase in the taxable process and go immediately to launch to try to accelerate the deal and not lose the market. And again, the VPA was executed on the morning of Wednesday 29th. You can see visually at the bottom of this page the different kinds of bonds. The light blue are serial bonds. the dark blue term, and then the gray bond is that long pack bond on the taxable side. We also show here what the absolute levels were at the end of the day on each of these bonds. Flipping the page to page 4, Lynn. What were the results? Well, we had $335 million in total orders. But the breakout was quite different between the two. 67 on the tax exempt side, there's a nuance there. We actually, before we engaged in some price adjustments, we had another $15 million, but we tightened things because of the oversubscription, and we had some investors dropped. So we started, before we made price adjustments, end of the day on the tax exempt side, we had $82 million in orders, 67 remained, and that was on a tax exempt transaction of $20 million. It was 3.5 times oversubscribed, or just shy of that. And we were able to make across the board price adjustments by 2.5 to 10 basis points on the tax exempt. On the taxable side, things struggled a bit more. There's been a lot of taxable issuance. Markets were moving against us. And this was a very large transaction. I would say that the three considerations here were size, volume in the marketplace, both on Tuesday and also leading up to Tuesday, and then market tone. With the taxable transaction, I believe going into indications, we were about $100 million shy of having the transaction done. Adjustments were made with indications. You'll see those on the next page. Yeah, the next page. We had to reprice to kind of correct for where the market was at on the taxable side, and adjusted yields up by 3 to 10 basis points on some of the bonds, not all of them. With that, we got additional orders of roughly $50 million. And at the end of the day, Bank of America agreed to underwrite the remaining $50 million, which shows us stepping up to the plate in a somewhat difficult market, but able to by and large get it done at we thought we're still very aggressive and strong levels. At the bottom on the right hand side, you can see where we underwrote. This is the underwriting that took place after we made the price adjustments. This is the $50 million of actual underwritings. And I might add that I'm not sure if it was with hours or a day or so, but we quickly placed all of those bonds, and they're all in the marketplace today. Flipping the page. This runs through the pricing progression. This is page 5. Here you can see, I think the most interesting thing is if you wanted to dig into these individual numbers, you could see the movements both in MMD and moreover the Treasury market. But I think you want to focus your attention over on the right-hand side, which was consists of the adjustments that were made. Green means that we improved yields. Red means that we had to move yields a little bit higher. And that's obviously the red dominates the taxable side and the green the tax exempt. Next page, just to put this in context, on Wednesday, the Fed met, and on I believe it was Thursday, Colorado priced the transaction. It was also somewhat sizable, $200 million. It was not priced by us, but the Fed change in rates, that is movement down 25 basis points, actually had the effect of moving rates up generally. So in spite of the fact that the Fed tightened, we were smart to get in early in the week. Frankly, that's generally our strategy. And I think one of the key things here is on the PAC bond, we were well through the Colorado PAC bond. Colorado's again a very, very strong AAA credit. And is in the market frequently well received, and I would view it as a strong comparable. And in fact, you see us you see Connecticut through Colorado across the board, but the PAC was particularly compelling, in spite of the fact that we had to adjust it up because of the marketplace.
Hey, Mike, if I
Yeah.
But to some extent, the difference in Colorado and Connecticut, fair to say, is the fact that tax rates are different. Connecticut tax rates are 7 versus Colorado's 40.
That's fair statement. Yeah. There is that difference. Connecticut has always been considered a specialty state. I don't even understand the term specialty state. It's always been considered high tax.
High tax on rich people.
High tax and a lot of rich people. Yeah. Tax exempt bonds are extremely well received. Colorado Philly has more and more rich people all the time, but, I think, as I understand the population growth there, but it does have a lower tax rate, so. Fair enough, although that shouldn't give you a 10 basis point difference. Just saying. Flipping the page, we have pricing comparisons there across the board. Tax exempt on the top, taxable on the bottom. Again, you see Colorado, we look right there. We were a little wide to Virginia. Virginia priced a day earlier. Virginia, I would also say, is a strong pricing comparison. I think Virginia, I actually don't know the taxable rate for Virginia transaction. It was a Bank of America sale, but I think they do have a slightly higher tax rate. I can check on that. And that's it by and large. There are some pages in the back there. I call these the Jerry pages. These are pages that we're carrying forward from prior transactions that show the movement and spreads over time. And Jerry's already pointed out that the gray for the our series on the tax exempts is near the bottom. And the green on the tax, I don't know why they switched the colors, quite frankly. But the green on the taxable is also near the bottom. That's our most recent sale. And then there's a bond distribution summary in the back here. You'll see where the orders were. I might just only note that these were the orders after the price adjustments, after that drop of, that drop of 15 million, because we tightened on the tax exempt side. And then the additional, I think it was Nuveen stepped in and bought $15 million of longer dated bonds with the reduction in, the increase in yields on the tax floor. And then last page 13 is the bond distribution summary, with, institutional versus retail. Retail broken down between national and Connecticut, and then institutional investors by type. That's my story.
I have a question on the underwriting on page 4.
Mhm.
A lot of times underwriting's for a maturity that just didn't sell. Looks like this was across with all the maturities in a very.
A lot of maturities had unsold balances. And wherever there was an unsold balance, we underwrote at.
Yeah, but it was like across the whole scale. It's like maybe.
Yeah, that it's true that I think it's true that typically a maturity or 2 or 3 or a part of the curve struggles. This transaction struggled a bit more across it. Now, again, when in asking our desk why this said, look, the market had been saturated with taxable debt. There'd been a lot the week before, a lot that week. It really, they felt, didn't have to do with anything about the Connecticut credit or anything like that. It had to do with going up particularly aggressively in a market that was saturated with a large transaction. That's the kicker.
Now, did you underwrite at the offered yields, or did you get?
We underwrote at these adjustments, the adjustments that show up on page, I think it's page 5. Yeah.
I'd just like to know, that's what kind of happens at the end sometimes, but the underwriter, well, they're gonna underwrite the bonds, they want a price adjustment, and then surprise, they sell them 2 hours later, but,
It varies a lot. If it were a 15, 20, $30 million balance, we very frequently, Bank of America, we have a lot of capital, and we put it to work underwriting bonds. We'll very frequently hold the price, the repricing conviction. Given that the size of this, it was $100 million out of a $270 million transaction, we did feel the need to make some adjustments. Plus, we knew the market was saturated. We were a little concerned that we'd be holding these bonds for a long time if we didn't make those adjustments.
Yeah, we did see, like, because I was in the city looking at the screen that when we were getting the indication, we did see interest from investors in the morning, but you get to the point when you get to the afternoon, all of a sudden, like, it stopped. And if we had a much smaller size, we would have gotten everything done.
right.
It's just like it seems like you hit a wall, and then the question is, what do you do? Do you just continue and wait, not knowing what's going to happen, or you essentially try to work and then get the book done?
The market tone was shifting.
Yeah, the market tone was shifting, just
As evidenced by the Colorado sale 2 days later. But
How do you view the 25% test and the availability of additional taxable bonds, especially in the multifamily space, maybe happening in 26 and beyond? And
How do I view it from a
Like in
bond
terms of a supply
issuance?
demand
Supply and
sort of,
demand?
yeah.
You know, I mean, Ansel may have thoughts on this. We've seen such significant pickup in volume in the last few years, and the market has absorbed it. You know, housing is such a small sector in the muni market generally, that I don't view this as you know, a big issue.
Big states like New York and maybe even California are predicting that they'll issue many, many more,
Mhm.
you know, bond deal transactions, if you will.
I hope they space them out. Yeah, New York very frequently decides to all come in December, and much to, you
Yeah.
know, much to their own detriment, their own detriment, because they're the ones who do it.
I mean, and
Sometimes
they'll
Massachusetts
tend to
does
be shorter term also, which I know is where we've had trouble in the taxable scale, so I
Right.
was just curious.
I'll follow up with the desk and see if they have their thoughts on that. It'll also, I mean, it would be interesting to get a firmer sense of, you know, who's really gonna benefit most from this, but I think you're probably with New York, California, but.
In comparing it to Colorado, we take into consideration any the prepayment speeds, like for example, with time to own. Like Colorado doesn't have that product, like doesn't have anything close to it. So if, I guess my question is, have we projected what the prepayment speeds are gonna be for a time to own?
We have not, and I can probably say that I don't think your investor base is digging into that. very
Because
deep.
we're a Ginny issuer and every day somebody talks to us about prepayment speeds.
Uh-huh.
So I can't imagine if people are buying bonds, comparing us to other HFAs, are we out there selling the fact that if you have a forgivable second of up to 50,000 previously, that would be in these bonds, that are people going to prepay it if they're at a 6% rate going to 6 and 5/8 going to 6? But they're not. I mean, it doesn't make sense financially. So I just wonder, is that message getting out to the bond purchasers? Because I would rather buy us versus Colorado.
Yeah, I mean, the PAC investors care, right?
Yeah.
But they are buying a lot of prepayment protection already.
Yeah.
That's a good
yeah,
answer, yeah.
Yeah.
Okay.
And then some.
But do they have to if they know, like, why would I buy as much prepayment protection if I'm already have prepayment protection built in with a $50,000 forgivable second?
Yeah, I mean, the HFA cash flow is like, you know, this bond issue is not a like defined pool, right? It's under a parity indenture, CHFA cross calls. So it's not as easy to model the cash flows given a prepayment speed as it is for, you know, an MBS buyer. But I think it is still relevant, and it is something that is disclosed, and I think there's been more focus on it, especially by taxable investors recently.
I think the people playing in the housing market, in the NRB market, are building into their pricing models what they want out of their pricing, a lot of variability in prepayment speeds, and you're paying for that, quite frankly. And I think your point is that maybe you shouldn't be, because but you know, a good comparison is a multifamily. We think multifamily should price better than single family because it doesn't have this prepayment risk, but you don't really see much of that.
I don't know if that's a really good comparison, because if I'm comparing myself to Colorado, I mean, if you sit down and do the numbers, if I'm at a $25,000 forgivable second, you got to save a lot of money based off of the size of the loans for you to prepay. So if we're not selling that.
I can tell you that people buying MBS are looking at that very, very carefully, because I worked closely with our desk.
I mean, maybe if we get more of a history, because as
they looked, in other words, at exactly what the refinance options were, what the impact was of down payment assistance on the likelihood of prepayment. That market, I think, is very,
it's not down payment assistance, it's a forgivable second.
Right.
So if I'm doing $25,000 or $2,500, I'm at a $200,000 first, you have to dramatically drop to make it worth your while to get rid of that second. Like, so, and that, if that's not being communicated to the bond, like, there's no comparison, in my opinion, between Colorado and Connecticut, but I think historically, maybe if we get some history, some experience, and we show, like, look at our prepay speeds a year from now.
Couldn't you model that, right? So you figure out how many time to owns we have, right? Because it's not every
single family loan we have, right? So figure out what it is and
Right.
then
You
make
could.
some assumption as to what the retardation of the prepayment will be. You could see what the effect is. It may not be that much. I don't know. I'm
Yeah.
just saying you could, but the problem, I think, to Mike's point is, that I think on your investors who are buying, they're not looking at that.
They're-
Yeah.
they're
I still look
building
at
in-
granularity, they're just not looking at it.
There's a big also distinction in that these are other than the PAC, these are par bonds. So MBS investors are buying at a premium,
Right.
and they're more
Got
at
it.
risk, right, with that premium.
Okay.
So the minimum prepayment speed that we've used for Moody's and S&P cash flows, like, isn't that sort of what Phil is driving at in a way? Because by ensuring that the floor is a little higher than zero, we're getting a little bit more value out of the fact that we have a forgivable second that's doesn't burn off.
That's, yes, there is value there too. Yep.
In this series.
You think there'd ever be value into packaging the time to own in a separate financing where we could really, market?
I mean, we're generally of the opinion that more disclosure is better, especially if you can communicate it to investors and get them to focus on that. We do have a kind of a set supply of investors. I'm not sure that everybody digs into every OS at this point to that degree, but that might be something we're thinking about, is both more nuanced, detailed disclosure on prepayment speeds and expectations based on your product, and figuring out a way to get that into the marketplace, which might entail some kind of special process as you initiate it, just to make sure that investors actually focus their attention there.
But there's been more focus on this in our space than there has been historically recently.
Yeah.
So,
And maybe the history will show, like, if rates drop and our bonds stay there more, then there's gonna be value added going
Mhm.
forward too.
That's a good point.
Any other questions? Since our financial advisor here, I'd like to maybe get your opinion on how the bond sale went.
Be careful on time.
Well, we did recommend that you accept the bid, so we thought the pricing went well. Yeah, we thought B of A did a nice job. We were pleased to see that they underwrote so many bonds. Not every firm is able and willing to do that. There's been a ton of supply in the taxable space. This was mostly a taxable deal. So yeah, we were very pleased with the results.
Any other questions on the bond sale? And on to financial reports with Allison Murphy.
Good morning. Before you are the October financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 34.7 million over budget through October and 46.8 million higher than last year. The increase in the authority's investment portfolio is a large driver of the year-over-year variance, as the portfolio is just shy of $1 billion higher than it was this same time last year. Bond interest expense is 15.5 million above budget through October and is 37.1 million higher than last year. Propelling the prior year variance is the $894 million increase in outstanding bonds compared to the same time last year. Servicer fees are 4.6 million higher than budget through October and are slightly lower than last year. Administrative expenses are coming in 5.7 million below budget and 785,000 higher than last year. When you exclude salaries and benefits of 25.3 million, the current year expenses are 81,000 higher than last year. And then lastly, the change in net position is above target by 26.8 million. Any questions?
Those bottom line results.
Mhm.
Report on.
Yep.
Any more questions on financial reports? On to production and delinquency report, John Chilson.
Good morning. For the month of October the the authority purchased 332 single-family loans totaling $95.5 million. For the first 10 months of 2025, the authority purchased 3,022 loans, which is 226 loans less than the first 10 months of 2024. However, in terms of dollar value, the $848 million of loans purchased is $11 million more than the first 10 months of 2024. And that again is because of the 7% increase in the average loan value to 280,000. So 98% of October's production was securitized. So that's 326 loans totaling $93.6 million. The MBS, the remaining loans there were 6 loans, or $1.9 million were whole loans. The MBS portfolio at the end of October was $4.1 million, which was $73 million greater than September. And the month-end September balance of the whole loan portfolio declined by 48 loans, or $4.5 million, and it ended up with a balance of $1 billion. The whole loan delinquency rate was 6%, and the carrying balance of loans in foreclosure year over year declined by $2.1 million to $10.4 million, and the total number of loans decreased by 18. For October, the authority also funded 70 down payment assistance loans totaling $831,000, average loan size $11,900, and 281 time to own forgivable loans totaling $6.6 million, average loan size $23,400. There were no new loan closings in our multifamily portfolio. The overall portfolio declined by 1 loan to 613 loans totaling $1.5 billion. There were 6 permanent loan delinquencies, and the overall delinquency rate for the multifamily portfolio was less than 0.5%. Any questions?
Well, there's a lot of detail there, but is there any like trends you would want to bring to our attention?
The trend would be that dollar wise, we're right on par with last year. And we're probably likely to hit the $1 billion mark again this year, which is also why our bond issuance is pretty much comparable last year. The delinquencies, I would say, is trending up a little bit from last year, which is not a surprise. The delinquency rate in 23 and 24 got quite low because post pandemic, all the federal programs, FHA, Fannie Mae, Freddie Mac, all came out with very generous modification options for borrowers. That really brought that delinquency rate down. Now, after we've gone through that period and things are settling in, the delinquency rate is starting to creep up. I think our foreclosure rate year over year is still very, very low. And I do anticipate as the delinquency rate goes up, the foreclosure rate will trend up too. But right now it's still surprisingly holding quite firm.
I've been reading a lot of articles about delinquency and foreclosure rates rising across the country. Increase in insurance premiums, taxes, and energy costs are driving that. How do you see Connecticut as it relates to other places?
Yeah, right now, Connecticut, it's still compared to the nation, fairly consistent. We are actually slightly higher, about 1/4 point higher. Our delinquency rate over Connecticut's around 5.75. I think nationally that's right around the same area, 5.75, 5.8. So that's not quite showing up in the delinquency rate, but Phil did make that point earlier. And as a result of that, I did reach out to a number of our servicers to see when they're making the call on a delinquent loan, what is the reasoning being given? And Idaho, which handles the bulk of our loans, said that the frequent answer is either real estate taxes and or insurance. Some of our more local servicers, how we're seeing the insurance issue coming up is that we're getting requests from borrowers either through lenders as they make the loan and or servicers that to increase the deductible, because the deductible, our minimum was $1,500, and that drives a higher premium. So we did change that, and we did increase the minimum deductible from $1,500 to $2,500. And then we're still getting a few requests, and just recently we considered one where the loan balance was only $125,000 on a $300,000 or $100,000 home, and they wanted to increase the deductible to $5,000. So we did grant that as a waiver, and are considering as a policy that if the LTV is less than say 75% or 70%, that we would get more latitude on the deductible, just to help keep that insurance premium low. And if there's that much equity, there's not much risk that they won't find the means one way or another to come up with that deductible should they have a casualty loss.
seems like it hits harder insurance premium increases for our clients.
Mhm.
Like if you're, it's only makes sense if your insurance premium goes up $100 a month and your payment's $1,200 versus, my next door neighbor whose payment's 4,000 and it goes up $100. It is definitely, it's an issue, but I don't think it's an issue just for Connecticut. I think it's for the United States. It's like the insurance, but you see some premiums, some of the people use it's like dramatically.
Yes, yeah.
That's a great option to at least raise your deductibles, give them a.
Yeah, yeah, the other issue too is some people are getting hit with the annual premium. There isn't enough in the escrow. Servicer calls the individual and said, you need to pay another 1,500 or 2,000 because of your premium increase. On a couple of cases, we usually collect that over a period of 12 months. We'll do the advance, we'll pay the premium and collect it back over 12 months. That still increases the monthly amount, $100, $200 on top of their P&I payment. So we've been stretching it over 36 months and then suggesting that they price other insurance carriers just to see if they're really getting a good rate.
I think there's also a sophistication level too, where like some of the people, when they, to your point, they're not shopping. They think like, well, it's just part of my mortgage payment. And then all of a sudden their mortgage payment goes up $400 and they're like, oh my gosh, what? And so it does trigger people to come back and ask.
Yeah, yeah, there's a disconnect because
They don't understand. Yeah.
right, that and the servicer's paying the premiums, so they don't have that one-on-one contact with the insurance company.
Right.
Right,
It's very true.
yeah.
Yeah. But
Madam
it's
Chair,
go up.
I've had my hand out for a while, so
Please ask your question.
I almost forgot the question, but I'm gonna go out of order. I'm gonna address the question that was asked about foreclosures. Because I get a lot of reports from the FDIC, the Federal Reserve, and obviously actual data from the banks when we examine them. At least in Connecticut, like one of the speakers mentioned, the foreclosure has not become an issue yet. Primarily because of the values of the houses, there's a lot of equity. So when people run into trouble, there's room to to do a modification, or people will sell. But in general, we have not seen either the feds or locally seen any issues to be worried about yet. There are some parts of the country, like it was mentioned, primarily due to insurance and secondary due to taxes, that there's been some issues, like in Florida and California, where insurance went up 5 or 6 times what it used to be a year or 2 years ago. That's been sticker shock to homeowners. So if your insurance was $2,000 and now it's $10,000 or $12,000, that is a tough, pill to swallow. But we have not seen that happen in Connecticut. So for whatever that's worth, that does not mean that next month I will not be saying something different, because the economy has a funny way to turn on you real quickly. The question I had goes way back when we're talking about numbers and the volume, and the statement was that dollar-wise, we're par with last year, but we avoided mentioning number-wise. So how are we doing with the numbers of mortgages we're buying? Are we more or less in the same level, or is the number significantly
Yeah,
lower?
so year to date, it's 3,022 that we've purchased for the first 10 months. And that's 226 loans less than last year. So we purchased fewer loans than last year, but the dollar value is about equal because of the.
Well, the values of the houses continue to go up, at least in Connecticut. It's kind of stabilized, but unlike
Right.
other states, we have not lost value. And in some markets, the value continues to go up. I mean, it's not going up to 8-10%. It used to go up, but it's still going up 2-3% in some areas in Connecticut. So
Right.
that will explain the dollar value. Is there any concern about the number? Do we have less people participating? Do we lose any partners, or simply, because of the rates, because of
Yeah.
market condition, the number's a little lower on the quantity side, not on the dollar side?
Yeah, we in terms of year over year, just like what John mentioned, we are approving as loan comes in, or if they are qualified, we are approving them. So we're not seeing
That's
drop.
it. My question
Yeah.
is there any particular trend or the reason you think that we have a lower number of loans, not dollar wise, but quantity wise?
I think
The
it's-
200.
Yeah.
Is it less participation? Is it has the market because the rates have stayed fairly higher than we expected it? That's just curious.
Yeah, I mean, I think it's hard to just pinpoint specifically.
I agree.
Can be either the inventory or the interest rate.
That was such a good.
So we don't specifically know. We know it's lower, but we don't know for sure
So
what it
last
is.
year, we had a pilot called Smart Rate where we wrote down the rate even more than normal for people who had student loan debt. And we were facing a couple things. One, the legislature actually provided for potential for smart rate funding through state appropriation. And so we've been sort of waiting to see if that will come through. But in addition to that, Hazim and I had a discussion earlier this year, and we've had a lot of headwinds coming at us with rates this year, as well as taxable, and you've seen sort of the effect of the taxable on our traditional mortgage rate program. And so we felt that buying it down even more was probably not feasible in 2025. We can revisit that in 2026.
No, I'm not suggesting we visit anything. I was just curious if we knew any particular. Is it a trend or is it simply, once in a while, there are peaks and downs,
Yeah.
All right, thank you.
Commissioner, another
Yeah.
point to consider too is like when we try to compare year over year, we also should look back what CHFA or the production CHFA has produced over a number of years. And what we did last year and what we're doing this year is something that we have never done in terms of count. So what?
And you know what? And that is a reasonable answer. That's one of the reasons I'm asking. Is it a trend? Is it something? Or is it simply, like for instance, if we had a new program last year that generated 500 or 600 additional mortgages than the normal, and that program is, now it's mature,
Right.
You're not going to have the same number of loans.
Yes.
So that's what I was trying to get at, to see if there was anything like
Getting
that. Or
numbers because of like expansion of products like renovation. Like I know you're expanding them.
Well, we're looking into that. Yeah.
But like, I don't know, one of the board members was talking about age of the inventory of the housing in,
Yes.
in Connecticut.
Yes.
So maybe that, because I do see that sometimes with borrowers, like they love the house, but they need to repair the roof and the seller doesn't have the money and they don't have the, so it's.
Right.
So maybe that.
Yeah,
that
we
will
have
help.
exciting products for 2026.
It's gonna come up with a tree.
We always have something in our back pocket
The
to
teaser.
consider. Yeah. I mean, we can't do everything all at once, as you know, like there's so much bandwidth that you can handle. So we're trying to manage it as best as possible.
Any other discussion on these topics?
well, I just want to make it clear. I was not trying to be critical. I was just trying to see if there was
Oh,
a
no.
trend,
Oh,
or there
absolutely.
was something that we should be paying attention to.
Is a good observation.
Okay, last item is the approval of the minutes of the Finance and Audit Committee of October 30th, 2025. May I have a motion?
So move.
So moving. This is George.
Second,
Second it.
we'll have a verbal vote. All in favor, say aye.
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 Opposed, abstaining, the minutes are approved. Any other topics people want to talk about? We have our strategic planning coming. You don't know.
You know what, Madam Chair, I'd be interested because I am getting back feedback on this part. Not so much concerns on foreclosure, but concerns around rental, which can impact our foreclosure numbers, right? Because you have a lot of properties that are rental. And I don't know if we have any data or do we know how the different projects that we have funded that have rentals, the capacity, what is their, vacancy rate? I'd be interested in knowing that because especially after the big debate that happened with the modified housing bill, there were several state reps that testify that the issue is not that we don't have enough housing units, is that the rents are so high, people cannot afford them.
Hopefully the market will come into play and bring the rents down. Like I know
I
some.
understand that, but I asked just curious if that's impacting our portfolio now, that's all.
Yeah.
Yeah,
we
we'd be happy to do a presentation at a future finance and audit.
Sure, sure.
Just to sort of point out, many of our portfolio properties have units that are rent limited because of the tax credit program, and so.
Okay, and maybe that's why it will not impact us. You know,
And
that's-
then
that's a
there's
good point.
subsidy associated with some of those units as well. But there's definitely some exposure, because there's.
But it's also good to check to make sure people are complying with what they're supposed to be compliant, right?
Absolutely. So we'll be happy to.
Yeah.
Do a presentation.
Thanks.
Although the flip side of that is that the rents are capped at a lower rate, so you have the demand.
But you can't.
But then you have to
Fine.
pay the insurance, well, you've got to pay the increasing insurance.
Yeah.
I mean, you're still rent
Property
cost, you could
taxes.
still be rent cost burdened, because the way that low income housing
Yeah.
tax credit rents are
Yeah,
set,
yeah.
they're not perfect
Yeah.
based on your income.
yeah.
And so you could be at a 60 AMI income, unit,
Right,
and still not be in a place where you're paying, and you could be paying more than
Yeah,
30%.
yeah,
right?
we usually price our rents at a 40% AMI. So that we give ourselves a window between the 40 and 60, because otherwise. You know, the number of people you can rent to is so limited.
And then that creates pressures on the operations, right,
Right.
and financial performance of
Right,
the
right,
portfolio
right.
and.
But what we're saying is, I mean, insurance costs and the real estate taxes are really.
Yeah.
Driving us.
Yeah.
Crazy.
The trifecta,
Yeah.
if you will.
We do get eyes on that too, though, because when we do the loan loss reserve, we're reserving for all loans that have a debt service coverage ratio less than 1.0. So that highlights for us the projects that aren't making it, that they aren't making enough revenue to cover their expenses. And those are the loans, obviously, that we reserve for.
Any other discussion items? Now I'll entertain a motion to adjourn. All in favor, say aye.
Aye.
Thank you very much.
Thank you.
you.